Welcome to the Economist in Your Ear podcast. We're facing an era of unprecedented technological advancement, with artificial intelligence leading the charge. But here's a thought-provoking question for you. Are we witnessing a genuine transformative revolution? Or could the soaring enthusiasm for AI be setting us up for a spectacular, painful fall? Today, we're going beyond the headlines to critically interpret the potential for an AI bubble. We're not just summarizing arguments, but really digging into the assumptions, challenging the framing, and bringing in some fascinating, contrasting perspectives that illuminate the bigger picture for you. Let's dive right in. The numbers fueling this whole discussion are, well, they're staggering. Since ChatGPT's launch back in 2022, America's stock market has ballooned by an incredible $21 trillion.
21 trillion, wow.
Yeah, and what's really striking is that just 10 firms, we're talking giants like Amazon, Broadcom, Meta, NVIDIA, they're responsible for 55% of that entire rise.
Just 10 companies, that's some serious concentration.
Exactly, and it's not just public markets. Fully 1/3 of the West's venture capital dollars have poured into AI firms this year alone.
A third of all VC money.
Mm-hmm. It's clear many believe AI is a total game changer. Some are even saying it's as big, if not bigger, than the Industrial Revolution.
That's a huge claim.
It is. And you hear investors talking about a race to create a digital god. I mean, with that kind of belief, you might think any amount of spending is justified, right?
Well, the sheer scale of that anticipation is certainly fascinating. But stepping back for a moment, we really need to ask if the reality is catching up to the hype. While there's this belief in a digital god, the current revenue generation from this, let's say, cutting-edge tech across the West's leading AI firms, it stands at about $50 billion a year.
Okay, $50 billion. That sounds like a lot.
It is, and it's growing fast, yes. But compare that. It's still less than 2% of the projected $2.9 trillion global investment in new data centers just between 2025 and 2028.
2.9 trillion.
Trillion. And remember, that's pure CapEx, capital expenditure, the money spent on physical assets. It doesn't even include the ongoing energy costs, which are massive.
Right.
So this brings us to a crucial point. How much of that massive investment is actually translating into returns?
Yeah, the payoff.
Exactly. A recent study by researchers at MIT found that a striking 95% of organizations are seeing zero return from their investments in generative AI so far.
95%. Zero return.
Zero return so far. It's no wonder we're hearing growing concerns about, irrational exuberance. Some analysts are likening it to Global Crossing reborn from the dot-com era.
Global Crossing. Not a good memory.
Not at all. And in fact, valuations in some AI stocks reportedly already exceed those of dot-com stocks back in 1999. Even a leading voice like Sam Altman of OpenAI has publicly said he thinks investors as a whole are overexcited about AI.
Huh. Even the insiders are saying it. So, given all that, is this just how it goes with genuinely revolutionary technology? Does enthusiasm always get ahead of itself? History certainly suggests that tech enthusiasm always runs ahead of tech realities.
Yeah.
There's this academic study, right? Looked at 51 innovations from 1825 to 2000. Found that 37 of them, a clear majority, were accompanied by speculative bubbles.
Right. Bubbles seem common.
But here's the kicker. Most of these bubbles didn't actually stop the underlying technology from ultimately sweeping the world. Think about Britain's railway bubbles in the 1840s, 1860s, or America's electric light craze in the late 1800s.
Yeah, the railways got built.
Exactly. People lost money, sometimes a lot of it, sure, but the infrastructure was created and, we still want to see it at night. So maybe it's a painful lesson for investors, but a societal win in the long run. Is that always how it plays out?
That's a crucial observation. History tells us bubbles come and go, but as one analysis points out, a digital god would be eternal. Even if the tech endures and transforms society, the consequences of a bubble bursting can be really profound, particularly for the firms leading the charge right now.
So the pioneers might not survive the crash?
Often they don't. When tech bubbles burst, the dominant companies often give way to upstarts. Many firms that led the early days of railways, telegraphs, telephones, they were quickly supplanted. It would truly be, well, let's call it a miracle, if all of today's magnificent 7 tech firms and the major AI startups still exist in a decade.
A miracle, huh? That's strong.
It highlights the historical pattern.
Yep.
So the critical question becomes, why do some busts cause more damage than others? Our analysis of past tech bubbles suggests 4 key factors really determine the severity of a crash.
Okay, 4 factors.
Yeah. The initial spark, the nature of the capital invested, how that capital is deployed, and crucially, who ultimately bears the losses.
That's a really useful framework. So let's look at the first one, the spark. How these booms get started. Is it always pure tech innovation, or do other things play a role?
That's a critical distinction.
Yeah.
Research from economic historians, people like William Quinn and John Turner, suggest that politically inflated bubbles tend to cause more damage.
Politically inflated? Like how?
Think of Japan's gargantuan asset bubble in the late 1980s. That was fueled by things like lenient property taxes and low interest rates, and it led to decades of sluggish growth.
Right, the lost decades.
Exactly. Technological sparks, by contrast, often do less long-term damage. Like the slump after the dot-com mania, painful, yes, but relatively contained compared to Japan.
Okay, so for AI, what was the spark?
Well, for AI, the initial spark was clearly technological. You had foundational research papers, like the one introducing the transformer architecture, attention is all you need. And then, of course, the public release of ChatGPT really lit the fuse.
Right, ChatGPT changed everything.
It did. But what's concerning now is that politicians are starting to add fuel to this fire. Governments, like in America, promising to trim regulation. Gulf countries pouring trillions into AI development. That starts to feel a bit more political.
Okay, so a tech spark, but now potentially political fuel being added. Got it. What about the second factor, the capital itself? Does the sheer amount and maybe the type of investment matter?
Absolutely. Historically, massive, concentrated capital investment can lead to widespread economic pain if it collapses. Take Britain's railway boom in the 1840s. Investment jumped from 5% to 13% of GDP. When that collapsed, unemployment doubled. Huge impact.
Wow. So how does the current AI splurge compare?
Well, right now, it's actually modest by those historical standards.
Yeah.
Maybe 3.44% of U.S. GDP over the past 4 years.
Okay, so not quite railway mania levels yet.
Not yet. But if those forecasts for data center construction are accurate, that $2.9 trillion figure we mentioned, that will change dramatically. The scale ramps up significantly. And what's more, an unusually large share of this capital is going into assets that depreciate really quickly.
Like the chips.
Exactly. NVIDIA's cutting-edge GPUs might look clunky in just a few years. The average American tech firm's assets today have a shelf life of only about 9 years. Compare that to telecom assets in the 1990s, they lasted around 15 years.
9 years versus 15, that's a big difference in how long the value sticks around. So this brings us to how that capital is actually used, that third factor. Is it creating enduring assets, things that last? Or just temporary infrastructure that quickly becomes obsolete?
That's the key question. Much of Japan's electronics capex in the 1980s, for example, ultimately served no useful function after the bubble burst, just wasted investment.
Right.
But bubbles can also benefit society if they create lasting assets, even if there's a bust. The railway manias, despite the crashes, built the backbone of England's rail network, still used today.
Okay, useful legacy.
Yeah. And the fiber optic cables laid during the dot-com boom, massively overbuilt at the time companies went bust.
Yeah.
But now, they facilitate all the data-intensive services we rely on, like streaming.
So the overbuilding eventually paid off for society.
In a way, yes. The big question for AI is whether today's massive data center investments will be similarly repurposed and enduring, or if they'll just become tomorrow's white elephants.
And finally, the fourth factor, and maybe the most critical one, if this market were to cool dramatically, who actually bears the losses? Who gets hurt?
This is where the picture gets quite nuanced, actually. When losses are spread out among many individual investors, the economic damage tends to be limited. That's what we saw after America's electronics and dot-com booms.
Okay, distributed pain is less systemic.
Right. However, if losses are concentrated among banks, like in Britain's 1860s railway bust, it can lead to a credit crunch and really deepen a downturn. Banks stop lending.
So what's the situation for AI? Are banks heavily exposed?
It seems less likely this time. Almost half of that forthcoming $2.9 trillion in data center capex is expected to come from the cash flows of the giant tech firms themselves.
Ah, so they're funding it internally.
Largely. And these companies are generally lightly indebted. Their balance sheets look pretty rock solid. Other major investors are likely non-bank entities, insurance companies, pension schemes, sovereign wealth funds, and increasingly private credit firms.
Private credit.
Yeah, firms like PMCO and Blue Owl, for instance, they financed Meta's huge $29 billion data center expansion in Louisiana.
Interesting.
So the takeaway is a crash here is probably unlikely to trigger a classic 2008-style banking crisis because the banks aren't the primary holders of the concentrated risk.
Okay, now this next point really makes you rethink the whole narrative. While comparing this to 19th century rail manias makes for dramatic headlines, maybe the situation is quite different. You mentioned the concern about fast depreciating assets like GPUs. But is that the full picture? Or are there ways that risk is perhaps mitigated in the AI space?
Yeah, looking at the bigger picture, it's probably a bit of an overstatement to treat GPU turnover solely as a sunk cost. I mean, sure, the GPUs themselves age quickly, technologically speaking, but the physical data center shells, the substations, the fiber interconnects, those are multi-decade assets. They stick around.
Right, the building and the pipes last longer than the servers inside.
Exactly. And the compute power isn't simply wasted when a new chip comes out. It can be repurposed. Maybe it goes from training the absolute biggest, most complex models to running inference tasks, which is using the trained model, or other high-performance computing jobs. We're even seeing GPU-backed financing deals emerge. Companies like CoreWeave are highlighting this. So there's residual value, there's reuse. That significantly mitigates some of the downside, even if demand for, say, bleeding-edge model training plateaus.
Okay, so the infrastructure isn't necessarily worthless if the bleeding edge moves on.
Correct. And furthermore, the framing around revenue models can be a bit narrow. The discussion often implies AI needs to be godlike to justify the investment.
Yeah, that it needs to be revolutionary or it's a failure.
Right. But we're already seeing a diversification of business models emerging. Things like agentic workflows AI that can plan and execute complex tasks autonomously. Vertical stacks AI solutions deeply integrated into specific industries like healthcare or manufacturing. And crucially, there's a growing focus on smaller, on-device or edge models.
Edge models, meaning AI running on your phone.
Exactly. AI running directly on your phone, your car, your device, not solely relying on massive cloud data centers. NVIDIA research actually suggested recently that small, not large models are the future of agentic AI.
Interesting. Smaller models as the future.
If that trend bears out, it implies lower unit costs and critically less cloud GPU intensity for many actual production tasks. That would significantly soften the bust scenario by reducing the sheer CapEx intensity needed.
So we've looked at the institutional risks. The banks seem relatively insulated. But the analysis we've looked at reveals maybe a more insidious and often overlooked macro vulnerability, one that could affect you, the listener, much more directly. If the risk isn't necessarily a 19th century style banking collapse or totally wasted infrastructure, what is the genuine macro vulnerability we should be watching?
That brings us to a really crucial point, and it's perhaps the most underplayed risk here. Household wealth exposure.
Household wealth. How so?
Well, look at the Federal Reserve figures. U.S. households now hold around 1/3 of their total net worth in stocks.
1/3 in the stock market.
Yeah, that's about $56 trillion in equities compared to $169 trillion in total net worth late last year. For context, at the peak of the dot-com bubble, it was 26%.
So a significantly higher proportion of household wealth is tied up in stocks now compared to 2000.
Correct. And while losses for institutions might be contained, this stock ownership is heavily concentrated among the wealthy. And it's their spending that powers a lot of our economic growth.
Right, the wealth effect on consumption.
Precisely. Oxford Economics estimates that consumer spending shifts by about 14 cents for every dollar change in financial wealth.
14 cents on the dollar.
Yeah. So in a market that's become so concentrated in just a few giant tech firms, many of them AI-related, an AI-led market drawdown would hit consumption much faster and harder than it did back in the early 2000s when the market was maybe a bit more diversified.
So the real risk isn't a bank run, but potentially a significant hit to consumer spending driven by falling stock portfolios heavily weighted towards these few tech giants.
That seems to be the more immediate macro vulnerability, yes.
Okay, so with all these complex factors swirling around the hype, the investment, the historical parallels, the specific risks this time, what does this all mean for what might actually happen next? If we move beyond just a simple boom or bust dichotomy, what are the plausible paths forward for the AI market?
Well, we can think about maybe three main scenarios unfolding. The first is what you might call a productivity catch-up or a soft landing.
The optimistic view.
Kind of. This path sees AI revenue rapidly ramping up to meet the existing capacity. Maybe through new software as a service applications, those agentic workflows we talked about, or highly valuable industry-specific models finally proving their worth. In this scenario, the massive CapEx growth cools down by maybe 2026, 2027 as utilization rates rise and some of the power bottlenecks get addressed. The market might see a modest correction, some multiple compression, but no catastrophic crash.
Okay, what would we watch for in that scenario?
Key metrics would be things like data center utilization rates, vacancy rates, and how enterprises are actually pricing and paying for these new AI services. All right, a second path could be a shift to smallage models or a rotation.
This is where those smaller models take over.
Exactly. This is where smaller language models and that on-device inference start taking significant market share, pushing the focus away from just the hyperscale training farms in the cloud. This could deflate parts of the GPU supply chain, maybe some specific data center builds, without killing AI demand entirely. It would just shift it.
So not a crash, but a change in who's winning.
Precisely. We'd likely see a rotation of winners, and that extreme concentration in the market indices might ease up a bit.
And to track that,
You'd look at benchmarks comparing these smaller language models, SLMs, new on-device AI features appearing in major operating systems like iOS or Android, and who's leading in inference per watt efficiency, getting the most AI done for the least power. Then there's the third, more challenging path. The CapEx income gap blows out, or a hard check.
this is the bubble bursting scenario.
More or less. This happens if revenues continue to significantly lag behind that $3 trillion plus in data center builds piling up, and if power delays persist, making it hard to even turn the centers on. In that case, we could see market multiples break significantly downwards. The combination of that market concentration and the household wealth effects we just discussed could realistically shave 0.3 to 0.5 percentage points off consumer spending growth in a year.
A noticeable drag on the economy.
Definitely. Losses would fall mainly on the mega-cap tech stocks equity and on those private credit lenders. Painful for investors, certainly, but still, as we discussed, unlikely to trigger a systemic crisis for the traditional banks.
And the indicators there.
You'd monitor things like revenue per GPU month, how much money is actually being made from these expensive chips, GPU resale prices, are they plummeting, and the spreads on private credit deals related to data centers and GPUs. Are lenders getting nervous?
Okay, 3 potential paths. But what then would truly break the trade, as some analysts like to put it? What would be the clear signal that we're heading for that harder check, that deeper problem?
Yeah, what's the real trigger? A key insight here points to narrative. One critical trigger would be if a credible worse than 99 story really takes hold in the market consciousness. Torsten Sluck at Apollo, for instance, argues that the valuations of the top 10 stocks now already exceed the top 10 valuations back in 1999. If their earnings momentum starts to stumble, that comparison chart could become a self-fulfilling prophecy, a reflexive sell trigger, even if the overall sector PE ratios are lower today than in 2000.
So sentiment and narrative could be enough, even if fundamentals aren't quite as bad.
Potentially, yes, given the concentration. Another major risk is simply policy or power shocks. Real-world constraints. If utilities genuinely can't deliver the promised electricity capacity on time, or if permitting and grid upgrades lag badly behind these ambitious build schedules.
Projects stall,
Cash flows get delayed, and the expected yields on these massive investments start to slip. The International Energy Agency's projections for future data center electricity demand. That is definitely the key physical constraint to watch very closely.
So putting it all together, while the immediate financial system seems relatively insulated from an AI bubble bursting in that traditional 2008 sense, the real and perhaps underappreciated vulnerability lies elsewhere. It's in its potential to hit household wealth hard, given the stock market concentration, and through that, put a real dent in consumer spending. The risk isn't just a simple bust, perhaps, but a more complex market drawdown that could reshape consumption patterns. And all this while the very architecture of AI might be quietly rotating towards leaner, smaller, edge-based models anyway. It leaves us with this final thought to chew on. Considering that potential shift towards smaller on-device AI models, how might that fundamentally challenge our current assumptions about what AI investment even means just a few years from now? Will we still be talking about trillion-dollar data centers in the same way? Thanks for listening. Follow us for daily insights into world affairs. And don't forget to like, comment, and share.